Welcome back to Intelligent Investment Live. I'm Garrett Lill with Matt Dahl, Matthew Dahl, as he says on the screen now. You're Matt to me. You can be Matthew on the screen, but to me and in my heart, you'll always be Matt. So Matt Dahl of ARPG, Las Vegas. Good to see you, man. It was October 24th, our last episode. So it's been, I guess 3 weeks. So good to see you. How you been?
Been doing good. Doing race car guy stuff, which was kind of fun to kind of get away from the office and turn some wrenches and kind of let your mind go for a little while. It's kind of a nice refresher. Now, I didn't put the Matthew doll in there. I don't know who did that. It wasn't me. I just work here. So
Yeah,
I'm fine with it saying Matt. I'm fine with it saying Bozo, the clown. You know,
Yeah, I don't know where that because I ran into that yesterday on one that what it had down. Maybe it has on there what like where I sent when I emailed the invitation to you. Maybe it takes that name. I don't know. I thought that was what you typed in when you first joined, but maybe not. So anyway, you've been racing cars for the last little bit. I'm sure that that's the great thing about this day and age. I'm sure you were still plugged into the happenings of the market and staying abreast of what was going on. But uh, government employees went back to work yesterday. You mentioned you sent an email out to clients. Talk about that a little bit because I love the headline of your newsletter to clients on the government shutdown or the end of the government shutdown.
right. So before I left to Florida, what was I, a week and a half ago? I guess I would have left there not last Wednesday, but the Wednesday before that. It was that Tuesday. I was in the office. I was talking with the team, and I've been frankly just impressed isn't the word. Just honestly taken aback by the resiliency of this market. Just how strong it is, no matter in the face of every reason to pull back, in face of the move that it made from April 9th through the middle of October into early November. The fact that uh, we had such a move coming into the weakest time of the year, and that weak time of the year was coupled with a government shutdown that was looming. Okay, all of those ingredients were put in place at the same time, right? And that is the perfect recipe for a pullback of 5, 7, 8, maybe 12%, depending on what happens. And it's anyone's guess. And the market really, other than a couple little 3 or 4% moves here, 2 or 3 day moves, it hasn't done anything. So back to that Tuesday, I was talking to the team, and I said, I was fully expecting a pullback sometime in the September October timeframe, just because obviously the market has moved so far. We're at a 23 times valuation, and we're going to a government shutdown. There's so much uncertainty now that will probably justify at least a pullback of one or two multiple points, right? Which it normally does, right? I mean, we had the shutdown in 2018 into 2019. We had a 10% pullback, okay? But that's a normal thing. But it never did that. And I when I was talking to the team, I said, I think the only thing that this market really is concerned about with now is those rate cuts coming into question. Okay, so let's look at that. Right now, the chances of a December rate cut, this is I'm talking 2-3 weeks ago now, were 96%. There was a 96% chance there was going to be a third rate cut this year on December 10th. Okay, and then what happened this week? Both the Kansas City Governor Jeffrey Schmid, he warned against future rate cuts. You look at the Atlanta Fed tracker; it's tracking for 4% GDP growth on an annualized basis. If you look at Q3 2025, that's incredible. Okay. Susan Collins said there has to be a high bar now that has to be overcome in order for her to vote for any future rate cuts. So now we went from 96% to we're about 44% right now. And that's what I think is bringing the market back. Now, I don't think the market what we saw yesterday was a 113-point loss on the S&P and about a 536-point loss on the Nasdaq, right? Now, what we're noticing today is a little bit of a bounce, but we're not getting a bounce back through and follow through. Okay. Now that may happen at some point in the future. I don't know. I doubt that it will. I think there's more to go. Okay. Although there's more to go, I also think it will be somewhat contained. The reason I think it will be contained is if you look at the AAII Bull Bear Index, we're at negative 17.5% bulls. Okay, so we have right now bears are at 49%, basically 50%. Bulls are at 32. Okay, so we've got a lot more bears than bulls anyway. So we don't have overexuberance with a bunch of people that now have to shift gears and then go sell. A lot of those people, they're not selling, but they're not buying already. So I think that will contain any sort of a huge pullback that accelerates into the 12 to 15% range. I maintain the position that we'll probably see a 6 to 8% pullback at some point in time, and this may be it. It may be nothing more than a future, this future rate cut being brought into question, a little bit of a stretch multiple. Sorry, we have to edit that out. A little bit of a stretch multiple.
You can't edit. We're live, man.
That's right.
No editing anymore.
right. A little bit of a stretch multiple, and the fact that we've seen this rotation now out of from NVIDIA, Meta into your healthcare, and some of those other sectors, like we've seen a rotation into biotech. Okay, so we're seeing sort of this kind of fits and starts, reasons for a pullback, reasons a pullback will be contained, and what could lead us to what could really lead us to anything deeper. But again, you always have to step back to your earnings, right? Earnings are strong. Okay, we've got 92% of earnings are in. Okay, 92% of earnings are in for this quarter or for last quarter. Okay, we have 84% beating, and that surprise, the average surprise is 7%. Those are very, very strong numbers. We have sales beating by 2.1%. Okay, we've got let me see. So, and in fact, the matter is the companies that have yet to report the earnings growth on the companies that reported were 12% above last year. Companies that haven't reported, their estimates are 24%. Okay, so if you blend what's actually has been reported, has yet to be reported, again, we're at 13.3%. So that justifies that 22.5 to 23 times multiple. Okay, so as long as we don't see anything going wrong there, and we're seeing 76% of companies beat on the top line by 2.1%, which is very, very strong. So if you take into account the Atlanta Fed GDP tracker that we're growing by 4%, we're beating earnings. In fact, I looked this morning. Last time we talked, we thought we were going to be about $270 a share, $275 a share this year, probably $305 next year. I think we were running in the 330, 335, 336 range for 2027. That's now up to 350. Okay, so we're seeing acceleration. We're seeing growth acceleration, right, on those out years. So there's a lot to be confident about and bullish about, but it doesn't change the fact that we might still this questioning future rate cuts or immediate rate cuts could pull the market back and give a lot of folks like us, I'm sure there's a lot of good advisors, money managers, a little bit of a better entry point, which is all we're looking for. Because I'm a long-term bull, I'm a bull's bull, I'm a bull that rides a bull. Okay, but sometimes you're just looking for a little better entry points. Not timing the market, just looking for a better price.
What are some other things? I mean, it seems like not to say that we're boring, but it does feel like every show we're talking rate cuts. Are we going to rate cut? Are we not going to get a rate cut? How much is the rate cut going to be? How many are there going to be? It's rates. Everything is interest rates. Does anything else matter in the market right now? I mean, I know other things. I'm not being totally facetious, but are there any other major factors that are contributing to this? It seems like right now at the highest level, you've got AI on one hand and the Fed on the other, and there's this tug of war between those two forces, and how much is which one's winning right now. Are there other variables in play right now? Earnings are always part of it. I mean, you've always got black swans and other things that can play into it, but are there any other major headlines that people are watching?
Well, so if you look at GDP growth, which is growing at 3.5 to 4%, if you take the AI and AI data center build out away from the GDP growth is zero. Okay, it is all there. That comes directly from Goldman Sachs. Okay, so we're seeing
pretty much all of our GDP growth is coming from AI.
Correct. All of our GDP growth is tech, AI based, data center based, and honestly, it's the margin growth that comes from AI, all of those things. So this gets us back to interest rates are a big part of it, because we're discounting those future cash flows to today's price. We're discounting that at a certain rate. That rate is that interest rate. So the higher the rate, the higher the discount, or the more we have to discount it. The lower the rate, the less we have to discount it, right? So, but if you look at these NVIDIA, right? NVIDIA comes in, estimate is for $1.25 a share next Wednesday. Okay, our estimate's $1.32. That's $5. So if you take the $1.32, that's $5.28 a share on an annualized basis, versus $4.64, which is what they're proposed to get this year. Okay, so if you look into so NVIDIA reports. So if you look at their they report in January for their annualized. So you have to look at their 2027 number. That's their 2026 number, if that makes sense. Okay, because it's a January number. So we're looking at their 2026 number is $6.76 a share. I think it's going to be over $7. But if you look at the 2027 number, which is end of 2026, that's the number we really need to be concerned with, because we're going into 2026. So 2026 is gone, right? So as we go into 2027, that's, I think it's $8.45 a share. We have based on its performance against guidance, we think that's going to be closer to $9 a share. You hang a 33 multiple on that, which is fair. You're $300 a share. Okay, end of 2026. So there's that growth, that AI story, that technology story, which bleeds into, which is a margin increase for Caterpillar, for United Healthcare, for Pfizer, for Bank of America, JP Morgan. That AI infrastructure bleeds through all the sectors and creates that margin expansion, which is where I think a lot of those earnings growth is coming from. And I think where a lot of that GDP growth is coming from, because we're exporting a lot of our AI technology to other countries, which is causing this nice organic growth. So to say interest rates are, they're always a big part of it. Of course, interest rates, inflation, labor, these are all, inflation and labor affect interest rates, right? Okay. So interest rates are important, but they are the manifestation of the data that's happening in the economy. So it's what's actually happening in the economy that affects the interest rates, that affects the market. Okay. But back to AI and technology and the earnings, that is of equal importance. However, if that falters, this high flying bird, this 23 times market will come down, and if we're looking at $350 a share for 2027, okay, that means as we get into 2026, what you could very easily make a case for a flat year next year. If we don't get the earnings growth that we're hoping for, right? Let's say we get, let's say we're not growing like we should. We only get to a 9% growth. That market's going to pull back to about a 20 times multiple, which is, by the way, still very, very good. Okay. And if you hang $350 a share on a 20 multiple, that's 7,000. That's where we're at basically now, so we're just a few points away from that, a few percentage points away from that. So if we hold kind of our 22.5 times or 23 times multiple in through 2026, and we can hang at $350 a share. Right now it's sitting at $348, but let's say we get to $350. That's where you're going to get the 7,700. But even at that stretch value, even holding a stretch valuation for that long, and getting that earnings growth number, I think a 10% next year. I think 10% next year on the market is going to be an ambitious goal. I think we'll get there. I think there's probably a better than puncher's chance we get 10%, 9-10% next year. But everything's going to have to go right.
And you kind of halfway maybe already answered my next question there, but when do you start putting together, you may already be in the middle of this now, putting together your projections for 2026, your end of 26 target price? I know this year, every that we've done this, you've given a number of where you think it's going to be. We're sitting almost exactly at where your 2025 number was. So that's always fun. When do you start that process, and what are you seeing or where do you think that's going to land if you have it ready yet?
That usually, I mean, again, it never stops, right? It's always ongoing. But as far as the application of it, that usually starts in earnest in October, and that goes through until into the new year, because I don't like to make big portfolio changes um, when we're still in a short-term capital gain situation. So I want to make sure that if I wait a week or two, it's not going to change anything. But any sort of any positions that we divest out of, right, that we replace that have done well, that we replace with something else, that the clients won't be treated to income rate gains; they'll be treated to long-term capital treatment, which is much far better to do. So, but like if you, so I think we have some good sectors next year. I think industrials are going to continue their strength. I think technology is going to continue to be strong. I think consumer discretionary is going to make a bit of a comeback next year. I think communication services are going to stay strong. Financials are going to stay strong next year. In fact, European banks are breaking out, right? European banks are breaking out. They're hitting their all-time highs, and they're taking off. You don't get these kinds of strong industrials, strong financials, strong global financials when you're going into some sort of an economic cooling situation. So back to Susan Collins and Jeffrey Schmidt of the Fed saying there's a high bar now for future rate cuts. They're not wrong. They're not wrong, because there's a lot you can make a case that the economy is doing well, and we don't have the data right now to know, are prices going back up? Are they staying still? Are they going down? Whatever. We don't have PC. We don't have CPI. We don't have PPI right now. In fact, back to that newsletter that I sent out yesterday to all the clients, does no data equal no December rate cut? That's very simple, right? So how can the Federal Reserve, in good conscience, make a policy decision to provide accommodation to the economy, or remove restriction from the economy, when the economy is doing very, very well from everything we can see, without having the data that says otherwise, right? Because they're without that data, I don't know that it's a mistake for them to hold until they get a series of data, because we've talked about this before. They always say one data point is one data point. It doesn't change. It doesn't provide signal. Signal they usually take from three successive months in the same direction. That's provided signal. So we don't have anything for October. We don't have any October data, and we're not going to get any October data. So, and the data that we receive for November is going to be kind of, it'll be a puzzle with a few empty pieces, because we're not going to have all the data that came in, because it just opened up on Thursday, which was the 12th or the 13th of the month. 2, we're going to have a lot of government workers that went back to work that didn't receive paychecks, and there's going to be some spending issues that took place in November that are kind of out of the ordinary. So, my guess is the market, I think today is doing a kind of a poor job of bouncing back. We lost 113 S&P points yesterday, 536 NASDAQ points yesterday, and the S&P is flat for today. That's not a good sign. In fact, it was up a little bit today. It's starting to bleed back down, and we closed at the lows yesterday, basically at the lows, close to the lows. So I think this pullback that we're in, I think we're at the beginning of this, but I also think it will be very short-lived. So that's what appears we're kind of facing right now. But again, we're not seeing any structural problems in earnings. Interest rates might not go down, but they might not go up. So we'll see what the bond market has to say. If the bond market can bring that 10-year back to 375, I think that will provide that next little leg to the market. If it starts to rally into December, we get some data that we need, right? I think that'll work. But this whole AI bubble thing is nonsense. We have real earnings. And frankly, we have really good multiples on these earnings. I mean, Nvidia is growing by, it's grown by, if it just hits its consensus, just the consensus estimate, it made 81 cents a share last year. Now it's $1.25. We think it's going to be $1.32. Okay. At $1.25, that's a 54% earnings growth year over year. Okay. And it's only trading at 29 times right now. I mean, that's back in 1999 and 2000, what did we have? They were trading on eyeballs. How silly is that? I got so many eyeballs today. And that was the metric that they used. There was no sales, there was no earnings, there was nothing. It was eyeballs. So this continued comparison of 1999 to 2025, I think is absolutely and utterly ridiculous.
Yeah, it's funny too. I was talking to somebody the other day about how even search is now like SEO on my website now. I saw something the other day, a year ago, literally a year ago, if not less than that. I had like an 87% grade on my SEO optimization from, through Squarespace that I did my website through. I'd done everything that I needed to do to show up in search engines and all that kind of stuff. And I look at it the other day, I'm like an 8% grade now, because now you've added AI optimization tools that you need to do. And I guess you do different things to try to show up on AI searches than you do for search engine. And I was talking to a client the other day who said that, his words were search is dead, that AI is now, is competing with or beating just traditional search. And it's changing. I mean, it's changing what I've got to do on my website, right? It's changing the game as much now. If you're still operating under the, the 2005, 2010, 2015 rules, you're way behind, and it's changing very rapidly. So we're already starting to see it, the impact that it's having. It's not just, like you said, just eyeballs. I mean, it's changing the way we do things. With the no data for October, nothing really in November. How important now are the reports that come out in December? Do they carry any extra weight since we haven't had anything for 2 months?
They do. In fact, well, the data that we're trading on right now, and I have this little note that, and I'm not a big fan of ADP data. In fact, Fundstrat calls it a random number generator. You know what I mean? But the data we have is the data we have. Okay, we don't have any other data, so that's the data we're going to use. So payroll, so ADP estimated that payrolls shed through the 4 weeks ending in October 25th. We actually lost 11,000 jobs in October. Okay. And then I wrote a little note on that, said, is that a high enough bar for you, Susan Collins? People start losing their jobs. Okay. But they have since then revised that to 42,000 jobs were created in October. And again, because of immigration now, we have a much lower bar to maintain our unemployment at parity. That number is about 50 to 60,000 a month. So 42,000 a month, that's not great, okay? But it's not disastrous. So as long as we're not hemorrhaging 150,000 jobs per month or something like that, that doesn't mean, but we don't know. But we don't know what the jobs number is going to look like. So when we see the December data, we see December data, and we get Jay Powell's press conference on December 10th. I think that is going to be some big market moving times, and I think everyone's going to be hanging on every word, yours truly included, to see what is he saying, what is he not saying, and how is he saying it? How is his language inflecting? Is he leaning hawkish? Is he looking into, hey, we're looking at 3.5 to 4% GDP growth here. We're looking at strong earnings in the markets. We're looking at an economy that's pumping on all 8 cylinders right now. There are issues in the labor market, and we have seen housing foreclosures in October just posted a 20% jump in foreclosures year over year, which is pretty staggering. So there's a lot of competing data points right now. There's a lot of tailwinds, headwinds, and cross currents that has to be sort of decided. So it will be all of that data that comes into the Fed and how they infer from that data and how they parse their message out. Are they going to parse it out more hawkish? Are they going to parse it out more dovish? I think, and this is one of the times I don't like doing this because it's not proven to be good for me in the past, but I'm going to disagree with my friends over at Fundstrat. I think they're going to lean hawkish. Okay. I don't want them to. I don't think that they should, but it doesn't mean they won't. Okay. So I think we might get back into a dovish sometime next year, but I think there's sort of this, we got 2 cuts and we have a strong economy, and Okay, now make the case for future cuts. If we don't have anything glaringly bad saying labor market, economy, well then why are we just lowering cuts to lower cuts? Okay. And it's anyone's guess.
Well, it'll make a very interesting holiday season this year. I know sometimes December can be a little bit of a boring month because a lot of people are waiting till January to make portfolio changes, but they may not get that luxury this year. So it could be a really interesting, last 30 trading days or so of 2025. As always, we are here for entertainment, education, and informational purposes only. If you would like to chat with Matt or anyone on his team, you can visit intelligentinvestment.com or give them a call at 702-655-8300. I encourage you to do that if you are looking for an advisor, but definitely don't take anything that we say and act on it without talking to a professional first, because we do not know you or your financial circumstances, so we're not going to tell you what to do with your money. Matt, thanks as always. Oh, by the way, I never say this. If you're watching the show, like the show, subscribe to the YouTube channel, do all that kind of stuff. I always forget to plug myself in these things, but hey, like the channel, subscribe to the channel. That really helps. It's amazing how much just asking people to like it increases your like percentage. It's crazy. You got to tell people to do that.
So, yeah, this is like junior high for me all over again. I just asking people.
You got to ask.
Please like me.
Yeah, I hate that. Like I hate the like and subscribe, because, and here's the thing that's funny about it is I just assume that everybody watching a video knows that we want you to like and subscribe because they hear it all the time. A lot of people don't, because I've noticed a huge uptick. I mean, nothing crazy, but you put out 2 videos that are identical. One says like it and another one doesn't, and you get 48 likes on the one that you say it in and 2 when you don't. So maybe we should say it more often. Just
like and subscribe.
Like and subscribe. Matt, always a pleasure. For everyone else, stick around and listen to the disclosure so we can cover that. And see you next week. Have a good one.
See you next week.
All right. Bye.
Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risks, and there is no guarantee of any future results, performance, or success.